when a mining company on, say, a yearly basis has a cost structure where they might be generating 10 or 20% EBITDA or profit margins, well, if you increase the revenue by 10 or 20%, that can have the effect of essentially doubling the profitability of the operation, depending on how that fixed cost structure works at some of these mining companies. For a royalty company, the really interesting thing is we're not exposed to the margins of the business. So if ounces come into the mine plan that are just mildly economic, they're wildly economic to the royalty company. And that's why royalty companies have outperformed, because a mining company might say, well, look, at 20% higher prices, we now have 1 million additional ounces that we can go mine, but the profitability on those ounces might not be great. Or the capital expenditure needed to actually go through with that expansion is very significant. The royalty company is not exposed to those two cost structures. And so that allows us to win and essentially participate in that upside without the cost of essentially bringing that return forward to investors.
Welcome back to Liberty and Finance. We have a returning guest. Kyle Floyd is the CEO of VOX Royalty Corp. He joins us this Monday, June 7th, 2021. Kyle, thanks for coming back on Liberty and Finance.
Yeah, thanks, Duncan, for having us. It's a pleasure to be back.
We had you on about a little over a month ago and got to talk to you about some of the questions around what makes royalty companies special. It's still a mystery to many of our viewers, so I do want to hit on that before we plunge into some of the viewer-submitted questions. People can understand mining. They understand, digging up the treasure out of the ground. But when it comes to royalty or streaming companies, specifically with VOX Royalty Corp, what is it? What's the business model? If you're not actually doing the mining, how is it that you make money, and how does it help you make money for investors?
That's a great question, Duncan, and it's a very healthy and I think helpful conversation to have for investors out there in terms of understanding what royalty companies are. Royalty companies buy interest in the underlying operations of mining companies. So not interest in the overall, say, corporate parent, but revenue-linked interests in the operations of different mines. And what that affords the royalty company and the royalty company's investors is to make money off of the production success of those operations. And so the royalty is typically a percentage of revenue from an individual mining asset that the royalty company then has typically a percent of that revenue for the life of that operation. Those revenue interests are very significant because the royalty companies never have to put more money into the project to continue getting that revenue stream. That's typically linked to the precious metals or metals price. And that means there's a lot less risk from both the standpoint that the royalty company is not exposed to any of the cost pressures that you would find with a mining operation. So when mining companies see cost overruns and margin contraction, that is not passed through to the royalty company. So when we find ourselves in this type of inflationary environment, we're not exposed to the rising prices and rising costs that it takes to pull the metal out of the ground that the mining companies are. And when they go to expand and further build out their operations, we don't have to contribute further capital for that growth. So it's a less risk investment, especially when you have a company like VOX that has 50 royalties and streams, now 51 after our announcement today. So there's a lot less risk, but very significant upside. And we can talk about how that upside isn't diluted as well.
Yeah, in fact, I want to zoom in on inflation. We're going to be actually having John Williams from shadowstats.com on this week. He's talked to us several times in the past about, depending how you keep your books and how you keep score, that the official, what he calls headline numbers like the Consumer Price Index, CPI, and other officially released statistics that are supposed to be informing us about what's really happening with the prices of things that people really care about versus our currency, in this case, the US dollar, often can be misunderstood, misguided, misleading if we don't understand the methods that are used for doing that. So he tries to set us straight on, look, guys, if they don't change the rule books, here's what they would be telling you. And that's why it's important to people who are earners, savers, retirees, that sort of thing. We have several questions that were asked by viewers ahead of this interview about how inflation is actually affecting our economy, how it's affecting mining and precious metals. And then I'll follow up with some questions about how it affects royalty companies in particular. But if you could start out with your view of how inflation is being impactful in general, but maybe with an eye towards the precious metals and mining and royalty companies?
Yeah, well, I think last time we spoke, Dunning, it was a little over a month ago. We referenced the super cycle, and I think we were pretty kind of early. After that, I think Goldman Sachs has come out and said commodities has become one of the best ways to play the current really kind of macroeconomic backdrop that we have right now. So I think we were a little bit ahead of the curve when you and I last spoke in terms of really calling for what I think we are, which is in the early stages of a super cycle that's in some parts driven by the inflationary pressure. So I think, one of the things is the government's trying to tamp down inflation fears and trying to get, I guess, speculation off of inflation. But look, we're all consumers. I think we all see what's happening when you go to fill up your car with gas, or you go to the grocery store, you're buying goods and services, whether it's Netflix or Amazon, doesn't matter. Prices are going up across the board. There's nothing the government can say that doesn't, I guess, disprove what we're seeing in reality play out. Well, guess what? That's happening in terms of commodities as well, and it's probably more acute. So in the context of mining and precious metals, look, it's very hard to see a world where precious metal prices don't continue to kind of re-rate and appreciate. And that's what we've been seeing. Gold has not maybe been the flashiest investment over the last few years, but it certainly performed very, very well. And I think for investors out there to be looking at gold and silver and the commodities, it might not have the meteoric rises and falls of something like a cryptocurrency, but the reality is that what you really want in your portfolio? If wealth preservation and wealth growth is what you're trying to accomplish, everyone can go speculate. Very few investors actually assemble a portfolio that's designed to outperform over the long term with a lot less risk or a lot less beta on those returns. And I think gold and I think precious metals, and I think in this inflationary environment where you're seeing cost pressure all over the place and commodities rising, I think the precious metals are a very, very good risk-adjusted way to play that trade.
In the past, Rick Rule from Sprott Asset Management, now he's Rule Investment Media CEO, has talked to us about how investing in precious metals at the right cycle of a bull cycle can bring long-term, multi-year gains. But he's talked about how mining companies and royalty and streaming companies can benefit with multiples of the actual underlying expansion in the price of the metals themselves.
Essentially, you're asking me how are mining companies and royalty companies levered to the precious metals and the commodity prices? It's a fantastic question. I don't think most investors get the opportunity to have this explained very often. With a mining company, a mining company might be producing, let's say it's 100,000 ounces of gold a year. They've got 1 million ounces in reserves, and then they have 1 million ounces, typically, maybe 1 million in inferred resources. Well, those inferred, so that let's call it those non-proven economic reserves or resources, with a rising metal price, can bring those ounces into the mine plan. So with, say, a 20% increase in metal prices, resources that previously were not economic. So say there's that million that additional million that needed higher metal prices now becomes economic. And so that's a very significant win for investors. And there are different companies that have different types of leverage to the metal prices. Now, the other area that a mining company has leverage is they have a cost structure. Well, if they are, so that's to overall volume of ounces and overall volume of revenue. But when a mining company on, say, a yearly basis has a cost structure where they might be generating 10 or 20% EBITDA or profit margins, well, if you increase the revenue by 10 or 20%, that can have the effect of essentially doubling the profitability of the operation, depending on how that fixed cost structure works at some of these mining companies. For a royalty company, the really interesting thing is we're not exposed to the margins of the business. So if ounces come into the mine plan that are just mildly economic, they're wildly economic to the royalty company. And that's why royalty companies have outperformed, because a mining company might say, well, look, at 20% higher prices, we now have 1 million additional ounces that we can go mine, but the profitability on those ounces might not be great. Or the capital expenditure needed to actually go through with that expansion is very significant. The royalty company is not exposed to those two cost structures. And so that allows us to win and essentially participate in that upside without the cost of essentially bringing that return forward to investors. So it's a distilled upside linkage in an inflationary or price rising environment that gives our investors leverage with a lot less risk.
You made me remember a family vacation that we did to the Black Hills of South Dakota. I believe we were in the small town of Keystone, and we were going on a historic mine tour where you put on a hard hat and you walk down in this old historic part of the mine. You see the old timbers that were still holding the place up, and the guide was explaining. And she explained that there was actually an operating gold mine had been still in operation across the highway from this place. She said, but they just had to shut down because it wasn't economically feasible to keep operating. This is back many years back, but the light bulb should have gone on in my head as far as being a contrarian investor, is that when you're at that point, that might have been a really great time to look into, investing in some mining stocks and that sort of thing. But that's exactly what the flip side of what you're talking about. Then when the metals prices on the open market are restored back to viable economic profitability points, then the different mining operations could bring resources back online again, just the opposite of what we were experiencing in that. The other thing you mentioned was inflation. And so people are really concerned about inflation hitting their household, their pocketbook, their retirement. You mentioned in passing a couple times here that inflationary costs are emerging in many, many, many areas of the supply chain and throughout industry. How is that going to affect mining specifically? And how exposed to that impact on mining? I think you've said it's that royalty companies are in a favored position if there's increases in costs, because you're looking at ounces, not costs. But help us understand that connection.
Yeah, and so royalty companies are taking typically a percentage of the revenue, and that revenue is tied to two things: production and the price of that underlying commodity or metal. And so when there's rising costs, and you see that there's going to be a lot of competition for the supplies that are needed to run a mining operation. And what are those? That's fuel, that's people, that's infrastructure, you name it. Mining companies have exposure to a lot of the inflationary pressures that they're also looking to solve by essentially producing metal. So mining companies are exposed to inflation. Royalty companies are less exposed to inflation because we don't share in that cost structure of the mining operation. We're just typically revenue-based royalty interests, which means we care about the production that the mining company is generating and the price of that underlying commodity. That's the multiplier.
Wow, it does. It sounds like the ideal place to be. You made me again remember, another personal anecdote. We had our dryer got repaired in our household, and the repairman, we couldn't get him to come out for a long, long time because he was swamped, busy. He said that, some people are laid off, but the people who are still working are drowning in work. Then he couldn't get the part. And when he finally got the part, he said that the supply, wholesale supplier who got him the part said, you said, you are so lucky. He said, you won the lottery. He said, this part is as good as gold. He says, everybody wants these and you got it. So we got the part. So that kind of supply chain breakdowns, difficulties obtaining spare parts, high costs of spare parts, trying to get the workers in, all of that just all of a sudden just went bingo. I can relate to it on a personal level, and your underlying miners are experiencing it on an industrial level. But you're saying royalty companies are insulated from all that fracas because they just get to look at the ounces coming off and the retail price of those ounces?
Exactly. So we're not exposed to those rising cost structures in mining operations. And usually those cost structures rise alongside of the prices, but that means that margin expansion is less. And so with a royalty company, that margin expansion should be more. And so that's offering your investors a lower risk way to play what we believe is this super cycle in this commodity trend north without a lot of those risks. And that means really at the end of the day, also more upside because your margins aren't getting contracted by rising prices and those inflationary pressures that we're all looking to mitigate.
When you've done scenario planning and financial forecasting for your company as a royalty company, what scenarios have you envisioned that might happen if, in fact, this inflation gets kind of run away? We've had a lot of concern from our viewers about the potential for hyperinflation or runaway inflation that the Fed is unable to or unwilling to tamp down, depending on what the impact might have if they raised interest rates and cooled off the stock market and all that sort of thing. Luke Renner says, what happens to the value of streaming companies when there is hyperinflation? Do the shares maintain real value? Yeah,
I think it's a great question. To be honest with you, I think there's concern around inflation is appropriate. When you look at the situation with the national debt, there's really only one way to get out of that, and that's to inflate. So, the Fed has a very difficult job in terms of trying to keep inflation probably at a higher number than it's been, but not so high that it absolutely kills the economy, which is a very, very delicate balance. And that creates really a tremendous amount of challenges for investors in terms of where do you put money. When we talk about hyperinflation, I don't know. I don't know if hyperinflation is going to happen. I think everyone believes that we're going to have a lot higher inflation than what we've seen over the last 15 years. And the challenge is going to be, really how do you play that? And how do you play that in a way that isn't exposing you to tremendous risk, but is increasing the cash flow in such a way that you can live and you can continue to have the quality of life that you have had. And so from our standpoint for VOX, while we believe that there is significant inflation and significant increase in commodity prices happening, we're taking a forward price deck that's lower commodity prices than we have today. So as an investor, well, yes, we share the sentiment with you that commodity prices are likely to go up significantly. I think there's a lot of fundamentals that back that up. When we go buy royalties, we use a price deck that is lower than where commodity prices are by and large today, significantly so. And so you can look at the VOX team as your pickers of assets with the technical team going out and finding undervalued royalties using a price deck that doesn't have hyperinflation kicking in and having gold going to 10,000. In fact, we typically are pricing in gold at 1,500 to 1,600. So when that happens, we're in fantastic position. But you can trust VOX and our management team and our capabilities in terms of selecting assets and our capital allocation to protect you, even in a world where commodity prices don't skyrocket. We should generate very, very good returns for our investors.
Yeah. So in other words, you guys are using a very conservative forward-looking model so that you only get into deals that really justify themselves in that viewpoint. Anything else above that is so much the better. Interesting. We have a couple of questions about the nature of the natural resources that royalties apply to, but specifically what VOX may have in plans or why VOX is focusing on out of these areas. Larkval says, according to their website, they do not own any uranium royalties. Are they ignoring this asset class or haven't found the right deal yet? A different one in the same vein, also about energy, PV says, what do you think about carbon credits? Is this a new source we should be thinking about setting up royalty companies over? Interesting, those are both about energy. People have that on their mind, but what royalties specifically are in your sights and going forward a part of your strategy?
So the first thing that VOX focuses on is hard rock commodities that our team really understands and that I also think that investors generally understand. And so that's gold, that's silver, that's platinum groups metals, which would be platinum, palladium, and that's really where our core focus is. That being said, we also can expand easily into copper, your typical polymetallic deposits, silver, lead, zincs. We really understand those well and have a team that understands those well. And I think the supply-demand characteristics of those metals, we also understand very well. When we get into different sets of commodities, say, for example, we acquired graphite royalties at a very, very good price. We've been able to partner with a company called Electric Royalties, where that's really their sweet spot. They're playing the battery metal matrix very specifically. And we saw our royalties as it concerned graphite as a better fit for that portfolio, which was not kind of in line with our long-term acquisition of royalties and what we're focused on. So we will focus on royalties where we see deep value. However, what we won't buy are ESG sensitive commodities. So something like coal, uranium in say half the investment community is looked at as ESG sensitive and half maybe not as much, but that's not something that we understand as well. It's not something that we want to take risk on where, investor sentiment can swing against something like uranium. So we're not in uranium, we're not in coal, we're not in assets or commodities as well that we think have some ESG sensitivities around them. And so when we do find great assets, if we do find a great uranium royalty, because we have this proprietary database of royalty opportunities, we'll look to partner with different companies and bring those royalties to their attention and get exposure in certain ways, but they won't be directly in our portfolio.
We have a follow-up question to something you just mentioned about the expansion of value opportunities that comes when you do see metals prices going up, and yet the cost structure you're not as exposed to. But the related question is, that's in terms of how it benefits your investors is in terms of your share structure. This question, on page 16 of VOX's corporate presentation, they state that one of the advantages of investing in mining by way of royalties is no dilution. However, when you read the latest financial statements, the company uses common shares to buy assets, gives stock options to employees, and issues warrants, all of which could cause stock dilution. How can they both be true?
Yeah, no, it's a very good question, and they're kind of different categories. So when we look at an asset and we have a royalty interest over that asset, as opposed to a company, so say you invest in an investment holding company and they buy the equities of a bunch of mining companies. And so therefore you buy the GDXJ, for example, that's equity ownership in the host of whatever the GDXJ matrix is in terms of what stocks they own at any given point in time. Well, those companies are having to heavily dilute to fund future growth. That means that your revenue linkage or your cash flow linkage in each share of those companies and that underlying index is diminished every time that they go raise capital. Now, our portfolio of assets, we are invested at the top line level of those particular assets. So when those same mining companies go and raise capital to go bring those projects forward, go drill, whatever reason is that they're going to the market, and typically increasing the value of those assets, we're not diluted. That being said, VOX in and of itself as a company and a corporate issuer will issue shares from time to time to fund some of our growth, compensation, et cetera. However, what you see with royalty companies is that growth through issuing equity very much slows. And you're finding VOX at that point in the cycle where equity is not expected to be a major component of any of our funding for new royalties. And the royalties in our portfolio are growing. We're not contributing any more capital for that growth, and that revenue interest is not being diluted. So it's a very good question. It's a very intricate question, but hopefully that sheds more light on how we're not diluted in the context of our royalty assets. Right.
Now, the last time you mentioned in passing just a few minutes ago about a proprietary database, and you mentioned it more extensively the first time that we interviewed you. We have a question from the same viewer. Says their website says proprietary database gives them a competitive advantage. Can you expand on this?
Yeah, well, first of all, I appreciate your viewers doing the work and going to our website. That's flattering, and I think good, very, very good due diligence. So that's terrific. What we look for is, in essence, we have a database that gives us the ability to find great royalties at great valuations across the board. So we have this database of now approaching 8,000 hard rock mining royalties, a lot of which, if not most of which, many of our peers are blind to. That's letting us screen for quality assets that have quality royalties over them, and then being able to find the ones that we could come to reasonable value on and bring into our portfolio. And so that database gives us a first mover advantage in terms of finding the royalties that we have and bringing those in the portfolio. And that's led us to become the fastest growing royalty company in the industry over the last 2 years.
And the origin of this database was something that some other company had assembled through their own research and you purchased from them?
Exactly. So VOX, we were building our own database, and we believed in, this is probably the topic of a future interview one day, maybe doing it, but we believe that third-party royalties were the best way to generate risk-adjusted commodity exposure in the favor of the investor. And so we built our company around that. And one of the things in building our company around that we sought out was competitive advantages with that business model and intellectual property that could really underpin a lot of those competitive advantages for long into the future. One of the ways we did that was building IP in terms of finding, it's very hard, it can be very, very difficult to find the royalties and the royalty owners. And so knowing where they are, knowing how to find the owners of this disparate set of worldwide royalties, we built a business model around it. And there was a company that was farther ahead in terms of their IP, intellectual property, around a royalty database than us. It was called Mineral Royalties Online. So we bought that database for $2.1 million in 2019, but started using it in 2018. And then since 2019, we've been the fastest growing royalty company in the industry.
You mentioned way back in the beginning of this interview that you just have a new announcement or new acquisition today. Can you talk to us about what's new? What's the announcement?
Yeah, so today we announced a royalty acquisition over Gold Standard Ventures Railroad Pinion project in Nevada. It's on the Carlin Trend. It's in the preeminent, I would say, gold territory of Nevada. And this was a really exciting royalty for us to acquire. As you know, and I think as we spoke about in our last interview, we have a first mover advantage in Western Australia, which is, you could say it's usually Nevada or Western Australia for the top mining jurisdiction in the world. And we've accumulated more than 30 royalties in Western Australia now to date. This is the first royalty that we've acquired in Nevada, and we're really excited about it. It was historically a group of a family that owned a ranch that was over this project and was essentially offered royalties in return for leasing that land to the mining company. And so this is how royalties get created. This is, the quintessential third-party royalty acquisition where we're finding really good value. We're finding a royalty that's over a great project in a great jurisdiction with a lot of upside for us as the project continues to inch towards production, which we would expect in the next, call it 3 to 4 years, in a great jurisdiction with a lot of inherent upside in the actual asset. So really exciting project for us, gold in Nevada on what will be a feasibility study project where they're announcing a feasibility study here in the next few months. So really exciting project for us to get exposure to for our investors.
Well, if you'll send me the information on the details about that announcement, we'll make sure to get it in our newsletter. I have to remind everyone who has not yet subscribed for our free newsletter that if you want to see the links and resources and details and descriptions provided on all of our interviews with all of our guests, including VOX Royalty, make sure you go to libertyandfinance.com, and over in the left-hand margin, you'll see a place to put your name and email address. Click submit. You'll get a confirmation email because you got to opt in, and make sure you get on our subscription for our every day sent out newsletter. And Kyle might make sure that we get this covered in that as well, so people can be more aware of it. If people want to find out directly from your company more about VOX Royalty, where should they go?
So the website is a great place, and it sounds like a lot of your viewers have visited the website and done their due diligence. They're also welcome to reach out to us directly at ir@voxroyalty.com. We're more than happy to answer various questions and give you more insight into our business and how we're building shareholder value.
Well, we appreciate your visits here with our viewers. I learn stuff every visit, and I'm sure our viewers do as well. So we just want to thank you for joining us here again on Liberty and Finance.
It's our pleasure. Thanks, Dunnigan.